The example we just saw considered only two states of the economy, an up and a down state. In the real world, things look a little different. Here we have the Standard & Poor's 500 price index going from 1998 all the way to 2018, so 20 years worth of data. It looks like a roller coaster with lots of ups and downs. So how can we assess this uncertainty? How can we measure risk for this index? Well, instead of looking at prices, we could look into the month-to-month return on the price index and plot it on a timeline which looks like this. Here we can see the ups and downs from month to month on the market. We could also generate a histogram of that data and get a graph that looks like this. And if you've ever taken statistics class, you will recognize the shape of this graph. It looks a lot like a Gauss curve, like a bell curve, also known as the normal distribution. And the normal distribution has an important characteristics. Its probability can be determined by two factors, the mean and the standard deviation. The mean relates to the average of the data points in our sample. And the standard deviation is related to how spread apart the data points are, meaning how much a roller coaster ride the market is giving us here. It's worth mentioning that depending on the data you're looking at and on the timeline of the sample, the distribution could look a little bit different than a normal distribution. It could be somewhat skewed to the left side, which could be related to how people react in bad times on a bear market versus how they react on a bull market. People tend to react in a stronger way to fear than they do to greed. The distribution could also have fatter tails, meaning that the probability of a very unlikely event here, where the market goes down a lot, could be higher than what is predicted by a normal distribution. Moving forward, we'll assume that the distributions are normal and that their probability can be determined by mean and standard deviation.